And I'm Heather Branch here with Mike asking for his insight on what you can be working on now as you get closer to retirement, or perhaps you're already in the first few years of retirement, but do you have the right plan in place? If you are wondering, if you have questions, Mike is here to help you get some answers. So find us at michigansretirementcoach.com. That is, of course, unless you're looking for Mike in the evenings when he is running back and forth and back and forth. You have 4 children, and every single one of them is different. Every time I talk to you, I'm just exhausted by hearing the limo service that you and your wife, Kimberly, are running out of your house.
Yeah, professional Uber driver is my part-time job.
Except you're not getting any tips from those kids. You know what you need to do? You need to set up a Venmo account.
Yeah, it's the non-paying version of being an Uber driver. Just from football to basketball to ballet to tap, dropping other kids off on our way through from one to the other. It's literally, but it's the best. It really is the best.
Yeah.
I wouldn't have it any other way. It just makes for some very tired nights.
Right. It's
but it's all good.
The currency of time, though, is one that is a tricky game to play, to try to understand, like you were talking about with your kids. Your oldest is 13 already. You were saying you turned around and he was as tall as you.
Yeah. Yeah. Little Gavin.
I know. Not so little anymore.
Yeah.
Anybody who is close to retirement, my dad says, he was like, don't blink. Before you know it, you're 60 and you're going, what the heck just happened?
Yeah.
And I believe it. I'm getting ready to turn 45 and I totally get what he's saying.
Mm-hmm.
But thinking about this phase of life that you help people figure out and understanding that, I mean, as with so many things, unfortunately, but really, if you have that financial foundation, most everything else will fall into place. You need to just know that money security is set up and ready to go. So I wanted to ask you about the notion of diversification, because especially people that are investors, I mean, you've been hearing your whole life about diversification and making sure that your portfolio is diversified. But when it comes to particularly in retirement, it's not just about having a variance of stocks and ETFs. It's also not even just about having a variance of what your money is in, thinking about having diversification of some in stocks and some outside of the market money, but the opportunity to diversify taxes is what this article on CNBC was talking about, because there are 3 different kinds of money on this list. They are saying money that has never been taxed, money that has already been taxed, and money that will be taxed when it grows. So let's talk about diversifying ourselves from a tax perspective, how to, if you will. And also, is this something, should all of us have all 3 types in our savings plan? How does this work? Tax diversification.
Yeah, there's different types of money that are out there. And the question is, do we want to proactively deal with taxes or reactively deal with taxes? So there really, you said there's money that's never been taxed, will be taxed, or will never be taxed. And so we always talk about they can be taxed today, tomorrow, or never. So if you think about the different types of money, we have 401ks. Everybody has a 401k for the most part, and that's your savings tool that you've had over the course of your life. Those are pre-tax, meaning you've got to put the money in. It's never been taxed. And the gains inside of it have never been taxed. So whenever you take money out of it, it will be taxed. That's a tax someday or a tax tomorrow model. There's also money that comes to you, and it's called non-qualified or like brokerage money. It's money that you got. It ended up in your bank account after you paid taxes, and then you decided to go buy some stock with it, or you decided to put it in a money market account or put it in a savings account, and you buy CDs with it, and you get these 1099s every year for the interest. Like a CD, you could buy a 3-year CD, but they make you pay taxes on the interest every year. You get a 1099, and that's what's called taxable accounts, meaning they're taxed today or taxed this year. You have to pay taxes and settle up every year on that money if it's traded or realized through the course of the year. So that's our taxable account. That's today taxes. Tomorrow taxes are the IRAs, the 401ks. And then there's the never taxed money, things like Roth IRAs, life insurance proceeds, things like that are never taxed. So if we look at, and I say proceeds, really it's death benefits that are never taxed. But so there's these 3 different pots of taxation. And we always work on diversifying our plan. If you don't understand how all this works, and even as I just walked through it, that was kind of a very cursory glance at it. But if you
Hmm.
want some more detailed explanation as to how this works and what types of money you have, because even as people look at their accounts and say, I don't fully understand it, we will help you understand at least what you have. And
Yeah.
so you can be informed on how it's taxed. But inside those different pots of money, you need to build a tax strategy for the future, because taxes are variable. We go through seasons of low or high taxation. If you don't believe me, just look back, type in to Google or, DuckDuckGo or whatever you use,
Yeah.
type in federal tax history chart. That's it. And it will show you that we've gone from no federal income tax before 1916 to a high point of 94% in 1945. And so taxes vary widely. It's one of the biggest things that administrations have to deal with in terms of policy. How much are we going to tax regular people? How are we going
Hmm.
to tax bigger corporations? How are we going to tax wealthy people and poor people? And how are we going to deal with this across the board? And another year of tax reform is next year, because the Tax Cuts and Jobs Act expires at the end of next year.
Right.
So it's another hot topic. What are we going to do with taxes? Um, as a result, you need to have some strategy. If they raise taxes in the future, how do I live my life the way I want to, regardless of a higher tax model? If you only have 401ks, you've only ever put money into a pre-tax model, and then you go to pull money out in the future, how would higher taxes affect that? Because let's say you only have pre-tax money, and you know that every dollar I ever take out to live off of will be taxed. Okay, well, then that's something we have to calculate in, because if you're in a 12% bracket today and that number goes to 20% in the future federally, how does that affect you, and how do you need to adjust? At the same time, in Michigan here, we're taxed at 4.25% on the state level. That's a flat number right now.
Hmm.
And so we need to build those numbers in. So to get out $50,000 to live off of, do we need to take out $65,000, or do we need to take out $58,000? Well, that
Right.
would change based on tax code. So we
Got it.
want to have some strategy. So the point of having these three different buckets of money is to say, well, in the future, if taxes go higher, do I have some money that's already been taxed? That way, if I take the money out, I don't have to pay taxes on it. We can do that through Roth IRAs. We can do that through long-term capital gains tax strategies on that
Hmm.
taxable account.
Hmm.
We just want to make sure we're aware of it. And again, taxes are something that we can proactively prepare for. Um, there's a lot of opportunities. The primary goal for most people is, over the course of my life, I don't want to overpay, right? It's
Sure.
not there's a set of rules we have to play by.
Yeah.
There is a tax code. We cannot cheat it. There's
No.
no way to beat it. But at the end of the day, we just want to live within it and win within it. And the best way to win is to not overpay.
Sure.
So having a blend of pre-tax, after-tax, and tax-free money, those will help you build a solid plan. And that way, over the course of our lives, we can determine what makes the most sense. I had a client who just recently, she inherited some money from a parent who passed away. And
Yeah.
as she inherited this money, one of the things she said was, well, how do we invest it? And I said, well, it depends on what type of money it is. Was it your parents' IRA? Was
Yeah.
it just regular money?
Hmm.
All these things. So we went through, and as we mapped it out, we said, all right, well, this money came in and is after tax. It's just from a regular, like a mutual fund account.
Okay.
So no IRA treatment, which means that when she received it with what's called a step up in cost basis. She didn't have to pay any taxes on what her parents grew it to.
Okay.
She got it today, and it's at today's value. So she could sell it, do whatever, and pay nothing in taxes.
Really?
Oh, yeah. It's very unique. And again, whenever we talk tax strategy, make sure you're working with someone who knows comprehensive financial planning and tax planning.
Yeah.
Because you don't want to have to run back and forth from a financial guy who says to sell to your CPA who says to hold, right? They should be on the
Yeah.
same page working together. And that's why it matters to work with a CFP. But so we went through with her, and I said, all right, well, based on your overall portfolio, we have so much of IRA money, so much of Roth money, and now we have this after-tax money. We want to build a custom retirement tax game plan for you that says, if the taxes go up,
Hmm.
here's where you get income from in the future. If taxes go down, which I can't see them going down anymore,
Mm-mm.
but if they were to go down or stay where they are, here's how we get income. And if taxes just go bananas, I mean, just crazy high,
Yeah.
And it seems like a crazy thing, but it's not. From
Mm-mm.
1929 to
Yeah.
1945, taxes spiked so high in 16 years. It was unbelievable.
Hmm.
Um, how would we live then? How do we still get the same lifestyle? So we had to build a plan out for that. And that was a retirement tax game plan. It understood the what ifs, because at the end of the day, all she really cared about is, how do I use this the best way so I can live my best life?
Right.
Her goal wasn't to be a tax aficionado. Her goal wasn't to cheat and try and outpace the IRS. It's
Yeah.
just to not get in trouble, but at the same time, not overpay. So that's what we did. We built a custom plan for her that made sense. It's complementary to her. She's a client. We walked through all the things, made sure everything made sense.
Yeah.
And now she feels comfortable that if the markets do whatever they do, her lifestyle doesn't change. So
Got it.
that's the whole goal. To make sure that there's a comfort there. And that's what we offer out to people. It's a custom retirement tax game plan. It's built for you and your family to protect you against the IRS, both today and in the future. Again, you just have to know the rules, play by the rules, and win within the rules.
Diversification means more than just a variance of stocks. What kind of diversification could benefit you in your retirement plan? This is the thing, it's different for everybody. So let's get to work looking at your setup, figuring out what will work best for your specific circumstance. Countries in over $35 trillion worth of debt. Where do you think taxes are headed? Have you put plans in place to better protect your money from Uncle Sam? If not, let's get to work on that.